All right, that was Hannah Belcher reporting from Sinai. Earlier, I spoke with Sinai, Chief Global Economist and Strategist at Decision Economics in Boston, and I asked him about the mixed roles of the strong Australian dollar and falling commodity prices and how they're contributing to the country's deficit problems.
Part of the shortfall and the creation of the budget deficit has come from a big slowdown in China and the impact on commodity prices in Asia. And Australia is a big commodity exporter. That hurt the exports of Australia, that hurts the economy, the revenues, and you get a shortfall against expenditures, and then you get that deficit. The strong currency, Australian currency, contributed to that commodity price reduction and the loss of exports, along with the external slowdown in the growth of China. The currency has stayed high relative to inflation, in part because now another currency, the yen, is being taken down massively in Japan, and the Australian dollar is much higher as a result of that. The answer to dealing with that is lower interest rates, and that the Reserve Bank of Australia is doing. Cutting interest rates, that takes down the Australian dollar with lags that will help Australia compete on exports. Australia can't do much about the commodity price declines that are going on. That's a worldwide phenomenon. They're just going to have to work their way through the impacts of lower commodity prices and lower export values from those commodity prices going down.
These commodity prices have had a tremendous benefit to the economy. The economy in Australia is special. 21 years of growth, essentially, and this latest economic crisis that the rest of the world basically felt in 2008 felt more like a speed bump probably to the Australians. But yet here we are, a talk of, for lack of a better word, some austerity programs, European style. Is it that big of a deal? Is it going to have a major impact on consumers in Australia?
A big austerity program a la Europe would be a huge mistake. It was a huge mistake for Europe. Fiscal consolidation is a better phrase. That means a more efficient way of cutting back on spending so it doesn't hurt the economy as much. And along with that, Australia should keep cutting interest rates. That will keep the Australian dollar lower and Australia more competitive on exports. Austerity is not the answer to the deficit.
You mentioned earlier that the central bank there has cut rates, and some are expecting to cut further rates again. But I just wonder if there's a bit of a double edge here. On one hand, you have commodity prices, which has helped increase the strong Australian dollar. But on the other hand, they want the Australian dollar to weak. Is it possible to really have both?
I think Australia needs to concentrate on not having a too strong Aussie dollar against currencies in the region and against currencies generally in the world. That would be the appropriate policy. The way you do that is through lower interest rates. The inflation rate of Australia, in part because commodity prices have been declining, is pretty low. It's in the around the 1.5 range. There's plenty of room for Australia to cut rates more. It could even cut it all the way into the ones to stimulate the private sector of the Australian economy to keep the Aussie dollar relatively low and to help revive its export sector. It isn't going to be able to control commodity prices. That is set in the world, not until China does a lot better. And next year, we think Japan does a lot better in its growth. Will Australia get the benefit of rising commodity prices again in terms of their economy?